Gold as an investment refers to the practice of purchasing gold in various forms, such as bullion, coins, or securities, to gain financial benefits or hedge against economic uncertainties. Gold has long been considered a store of value due to its scarcity, durability, and global recognition. Unlike paper currency or other assets, gold does not depreciate due to inflation or political instability, thus offering a sense of security for investors seeking to preserve wealth over time. The significance of gold as an investment lies in its role as a safe haven asset. During periods of economic turbulence, investors often flock to gold to protect their portfolios from market volatility and currency devaluation. This aspect of gold makes it an attractive option for diversifying investment portfolios, reducing overall risk and providing a potential hedge against inflation. One example of gold as an investment is its use during the 2008 financial crisis. As stock markets plummeted and global economies spiraled, the price of gold surged as investors sought refuge in its perceived stability. Similarly, during the COVID-19 pandemic, gold prices reached new highs as market uncertainties and fiscal policies raised concerns about inflation and currency value. These examples illustrate gold's enduring appeal as a protective asset in times of global financial distress. Supporters of gold as an investment argue that it remains one of the few tangible assets that can maintain its value over the long term. They point to historical data showing how gold prices have generally increased over decades, despite short-term fluctuations, reinforcing the idea of its role as a reliable store of value. However, investing in gold is not without challenges and controversies. Critics argue that gold does not generate income like stocks or bonds, making it less suitable for those seeking regular returns. Additionally, the value of gold can be subject to speculation and market sentiment, leading to price volatility. Alternative viewpoints suggest that other investments, such as real estate or technology stocks, might offer more significant growth potential in modern markets. Gold's role as an investment intersects with other aspects of financial planning, such as asset allocation and risk management. By providing a diversification option, gold can influence decisions on balancing portfolios to optimize returns while minimizing risks. Understanding gold's position in the broader investment landscape helps investors make informed choices about how to incorporate it within their strategies. The historical performance of gold refers to the analysis of gold's value fluctuations over time and its behavior during various economic conditions. Historically, gold has been revered not just as a commodity, but as a symbol of wealth and stability. Its performance provides vital insights into its role as an investment asset. Over centuries, gold has maintained intrinsic value, often acting as a financial safe haven during economic instability. This historical context is essential for investors considering gold as part of their portfolio because it influences perceptions about its stability and reliability as an investment. The significance of understanding gold's historical performance lies in its reputation as a hedge against inflation and currency devaluation. For instance, during periods of high inflation, such as the 1970s, gold prices soared as investors sought to preserve their purchasing power. Similarly, during the 2008 financial crisis, when stock markets plunged, gold prices spiked as it was perceived as a safer store of value. These examples illustrate gold's potential to balance market volatility and protect investments during economic downturns, making it an attractive option for risk-averse investors. Supporters of gold investment often highlight these historical performances as evidence of its enduring value. They argue that because gold has consistently held or increased in value over time, it should be a staple in any diversified investment strategy. However, despite these optimistic views, there are challenges and controversies surrounding gold investment. Critics point out that gold, unlike stocks or bonds, does not generate income or dividends, potentially limiting its long-term growth prospects compared to other assets. Moreover, the volatility in gold prices can also mean that it doesn't always perform well in short-term investments or in stable economic conditions. Furthermore, the historical performance of gold influences other aspects of the discussion around gold as an investment. It impacts decisions on portfolio diversification, offering a baseline for comparing gold to other investment classes like equities or real estate. Additionally, the historical context of gold's performance during various economic conditions informs debates about whether gold should be considered a core investment or merely a complementary asset to reduce risk. In summary, examining the historical performance of gold provides a comprehensive understanding of its potential benefits and drawbacks as an investment. It underscores gold's role as a protective asset during economic uncertainties, while also recognizing criticisms related to its lack of income generation and price volatility, thus fostering a balanced discussion on its place in a modern investment portfolio. Gold market dynamics and factors. Influencing value refers to the forces and factors that drive the fluctuation of gold prices and its market trends. These dynamics are shaped by a variety of elements, including supply and demand, geopolitical stability, currency fluctuations, interest rates, and broader economic trends. Gold is considered a global commodity, and its value often reflects investor sentiment towards risk. When markets experience volatility, investors typically flock to gold as a safe haven, which can drive up its price. Understanding gold market dynamics is crucial for anyone considering gold as an investment. For instance, during times of political uncertainty or economic downturn, the gold prices tend to rise due to increased demand from risk-averse investors. Conversely, when the economy is strong and interest rates are high, gold may become less attractive, leading to a decrease in its value. A real-world example illustrating this is the financial crisis of 2008, which saw gold prices surge as investors sought refuge from the collapsing stock market. Another example is the impact of inflation on gold prices. As inflation rises, the real value of currency decreases, making gold an attractive hedge against devaluation, as seen in recent years, where an economic uncertainty has led to increased investment in gold. Some experts and financial analysts argue that gold should be a staple in any diversified portfolio due to its historical resilience and its role as a hedge against inflation and currency devaluation. However, potential challenges to investing in gold include its lack of yield compared to other investments like stocks or bonds, which can generate income through dividends or interest. Additionally, while gold does provide security, its price is also susceptible to sudden drops influenced by factors such as changes in mining activities or unexpected shifts in central bank policies. This point profoundly connects to the broader topic of whether gold is a good investment by highlighting the cyclical nature of its value and the economic principles governing its trade. Understanding these dynamics allows investors to balance gold's role as both a hedge and a non-yielding asset within their investment strategy. It underscores the importance of analyzing market conditions and economic indicators when determining the viability of gold as part of one's investment portfolio. When considering whether gold is a good investment, it's crucial to compare it with other investment options like stocks, bonds, and real estate. Gold is often viewed as a safe haven asset, which means it tends to retain its value or even appreciate during periods of economic uncertainty. In contrast, stocks and bonds can be more volatile, and real estate investments require significant capital and can be illiquid. The significance of comparing gold with other investments lies in its unique characteristics. Gold is a tangible asset, immune to inflationary devaluation, while paper assets like stocks and bonds are subject to market fluctuations and economic policies. This distinction makes gold an attractive option for those looking to diversify their portfolio and hedge against inflation and currency risks. For instance, during the 2008 financial crisis, gold prices soared as investors flocked to its safe haven status, while stock markets plunged globally. Similarly, in response to economic uncertainties and geopolitical tensions, gold often performs well, as seen in the recent pandemic era, where gold prices reached all-time highs. Opinions supporting gold as an investment often highlight its historical stability and enduring value. Proponents argue that gold provides a hedge against inflation and currency fluctuations, preserving wealth over the long term. They also point out that gold's performance is often inversely correlated with stock markets, meaning when equities fall, gold can rise, offering a balanced investment strategy. However, there are potential challenges and controversies associated with investing in gold. Critics argue that gold does not produce income or dividends, unlike stocks and real estate, which can generate cash flow. Additionally, gold's value can be subject to market speculation, resulting in short-term volatility. Some financial advisors suggest that too much investment in gold may hinder portfolio growth, as it lacks the growth potential of equities or the steady income from bonds. This comparison influences other aspects of the investment discussion by highlighting the importance of diversification. Rather than viewing gold as a standalone option, it should be considered part of a broader investment strategy that includes a mix of assets. This approach mitigates risks and leverages the advantages of different asset classes, aligning with individual financial goals and risk tolerance. By comparing gold with other investment options, investors can make informed decisions that balance the benefits and drawbacks of each, tailoring their strategy to suit their unique circumstances and market conditions.